Now, so the balance carried down, when you move to the next period, is going to be balance brought down. And that will be 5,000. Okay, so that's how to balance up an account. So one, you have to total the debits and total the credits. And pick the one that is bigger. Then you insert the difference, what becomes the balance carried down. Now, so if you go back to any question on this, any question? Any question? Okay, all right. So if we come back to what we're discussing, you see that we have balance as per the cash book. So this is the balance brought down. Okay, so it meant that at the previous page or in the cash book, the totals of the debits was more than the totals of the credits. And therefore, there was a balance carried down, which was inserted. And that balance carried down has been brought down here. So the balance as per the cash book is the same as the balance brought down. Okay. Now, if we go through this, you see that we have the totals of the debit and the totals of the credit. But because the totals of the debit is more than the totals of the credit, then we have a balance carried down. Now, for the bank account, when you have the balance carried down at the credits, it means you have money at the bank. For the bank account, anytime you have a balance carried down, which is at the credit, it means that you have money at the bank. So when the balance carried down is at the credit, when you move to the next page, it's going to balance brought down, which will be at the debit. So remember that all assets have debit balances, okay? But for the bank account, it is possible that you may overdraw your account. So if you overdraw your account, then it means that the totals of the credits will be more than the totals of the debits. So if the totals of the credits are more than the totals of the debits, then the balance carried down will be at the debits. So if you have the balance carried down at the debits, it also means that it is an overdraft. You can conveniently say that overdraft. Is that okay? Can we continue? Can we continue? Hello, are you guys there?
Yes, please. So we can continue.
Yes, please.
All right. Yes, Bismarck.
Please. Is it that anytime you have a balance carried down at the debit side, when you move, when you come to the opposite side, it will be at the credit side, the debit side?
Remember, there are two terms. So balance carried down and balance brought down. They are different. It's a carried down that is brought down. So if the carried down is at the credit side, then the brought down will be at the debit side. If the carried down is at the debit side, then the brought down will be at the credit side. Is that okay?
It's okay, sir.
All right. Okay. So remember that this is how to prepare the adjusted cash. And once you've done the adjusted cash, yes, Ben said.
I was asking that, so all overdrafts can be balanced per the cash book at the left-hand side, which is at the debit side.
Sorry, can you ask your question again?
I'm asking that all overdrafts.
Emilia, I'm going to remove you from the class. Yes, Benson, go ahead.
Say, I was asking that it's all overdrafts at the debit side of the cash book.
All overdrafts at the debit side of the cash book.
Yeah, that it can be found at the debit side of the cash book.
So if we have a balance, anytime you see a balance go down at the debit side of the cash book, then it is an overdraft.
Okay.
Or similarly, anytime you see a balance carried down at the credit side of the cash book, there is an overdraft. Because it's a balance carried down that is brought down.
Okay.
All right.
Thank you, sir.
Okay. Now, so once you finish with the adjusted cash book, then you can go ahead and prepare the bank reconciliation. And it's similar to what we discussed the last time. I thought that I should explain to you the adjusted cash book using the T account. Okay. Any question? Any questions? Yes, Leighton.
Good morning.
Yes, good morning.
Anytime before you do the
Can you speak up?
Can you hear me? Sir, can you hear me?
Yeah, I can hear you now.
What I'm saying is, so that means anytime a person is giving the bank reconciliation, before you do that, you go to the other one. You do that one before doing the bank reconciliation, or they are two different things.
Yeah, so you have to do the adjusted cash because you are going to reconcile the adjusted cash position or the cash balance with the bank statement balance.
Okay.
Yes, Benson.
Yes, it was the previous one which was up.
Okay.
Thank you.
Andrea.
Sir, the balance brought down at the debit side.
Yes.
I understand from my layman's understanding, because the balance, the CD on the credit side.
Yes.
Is this because of the principle of double entry, or what is the implication of you bringing the balance brought down the 5,000, the debit side?
Okay. Let me go back. It's not erased. It is straight. So, you see, what we're saying is that if you look at what we have totals of 20,000 at the debit, the totals of 15,000 at the credit. Is that okay? It means the totals of the debit is more than the totals of the credit by 5,000. So if you net it, then what you're saying is that you have a difference of 5,000 at the debit. So that is the balance brought down. So if you insert the 5,000, then the two sides will agree, 20,000, 20,000. But the credit side is not 20,000. The credit side is 15,000. It means that you still have 5,000 at the debit. And that's why we have the balance brought down at the debit. So when the balance carried down is at the credit, then the brought down will be at the debit. Is that okay?
Yes. So that means it's a principle that anytime there is a carry down, there must be a brought down.
Yes.
Okay, thank you.
Anytime there's a carry down, there must be a brought down. Okay. Any others? All right. Okay, so today we want to discuss the financial statements. So these are our learning objectives. One, I'll explain to you the objectives of financial statements. Then we'll look at the components of financial statements. Then we obtain an overview or a relationship between the elements of the income statement and the statement of financial position. So we'll look at how the income statement is used into the statement of financial position or the balance sheet. Then we will look at the structure of the income statement for some type of businesses. Then also look at the structure of the statement of financial position or the balance sheet for different entities. Now, when usually the financial statement will come as part of the annual report. It will come as part of the annual report. And the main objective of the financial statement is to provide information of an entity with regards to the financial position of that entity. In the financial position, we're looking at the assets, liabilities, and equity. Then it will also provide information about the financial performance, i.e., the revenues that were earned, the expenses that were incurred. Then it will also show the cash flows of that entity. So here we're looking at revenue generation, cash flow generation, and cash flow usage. But this information, i.e., the statement of financial position, the financial performance, and the cash flow, is useful for decision making by many. So we refer to this kind of financial statement as a general purpose financial statement. So the financial statement that we discuss is a general purpose financial statement. Why do we have to say that it's a general purpose financial statement? Why is it a general purpose financial statement? Yes, two more.
Hello, sir.
Yes.
Please, I was listening to you, but if I beg.
I'm saying that okay, so Kelly, Leonie.
So if I understand well, I believe it's a general purpose financial statement because it just gives a general view of how a general financial position of the company. It doesn't give the details. It doesn't break it down to. I don't know.
Okay, so that's a good try. But yes, who else? So basically, if you have resources or if you have money, you can commission a special purpose financial statement. Yes, Francis.
As I think it's general because it has to do with, I think all elements are inclusive. That's why.
Okay, yes, Steven.
I would comment as a general purpose because it provides information about the results of a business and financial position and the cash use of an organization.
Oh, all right. So it's a general purpose because the information is useful to, it does not have anybody in mind. Okay, it does not have anybody in mind or a particular user in mind. Now, if a particular user has resources, they can commission a special purpose financial statement. So this financial statement is available to all users and it does not intend for one specific purpose. So that's why it's referred to as a general purpose financial statement. Okay. Now, if we say there's a general purpose financial statement, then it must meet these. So one, it must provide cash flows about the entity. So here we're talking about the cash that were generated and the cash that were used. We're talking about the resources or the assets of the business. It must also provide information about the liabilities. It must show owner's interest in the business. And finally, it must also show the income that were earned and the expenses that were incurred. including gains and losses. And there must also be a reconciliation of the equity. So here we're looking about contributions and distributions to owners. So if we are looking at the general purpose financial statement, we're saying that is to provide information about the financial position, about the performance, and about cash flows. And it must meet this. Okay. Now, what we need to understand is that information that is provided, and usually when we look at the components, we see that we're talking about not just the financial statement, but also the notes, the accompanying. So the accompanying notes, together with the financial statements, must provide information that can enable a user predict the entity's cash flows. But in predicting the cash flows, they must also be able to predict their timing and sensitivity. So they should be looking at the risks associated with the cash flows, and they should also be looking at when that cash will occur. Why is it important to look at the risks associated with the cash flow and the timing of the cash flow? Why? Yes, Timmy. Or is the old one? Timmy.
Is the old one, sorry.
Okay. Anybody else? Are you guys in the class?
Yes, we are.
Yes, we are.
Yes. So if the information is to provide, information provided is to help users to predict future cash flows, and we are looking at in particular about the timing and sensitivity. Why is it necessary to look at the timing and sensitivity? Yes, Kelvin.
So that maybe investors could be able to make decisions as to whether to invest at a particular time or not.
Okay. Okay, so the timing, because there's a time value of money. Okay, because there's a time value of money. Yes, Andrew.
Well, I think it also helps to properly know when to allocate resources and know when you get the returns.
Okay. Yes, Steven.
No, please, the cash flow party, in order to know the cash flow party, by controlling the expenditure and unnecessary items for investment.
Okay. Yes, Abdul Manan.
To know the sort of risk to take at a particular time with regards to the business.
Okay, so the risks are so we're interested in determining whether they will occur. If the amounts that you have said that is going to happen, whether there's sanctity about it. So you may be looking at the cash flows, and in predicting, you're saying that the cash flow will be 100,000. But if you apply rates to them, the probability of its occurrence may be 50%. So that is what you should know. So then you should know there's sanctity. So if you are now looking at the cash flow, then you cannot say that it is 100%, because the probability of it occurring will be a 50%. So it is important to know the timing and whether the amount that has been stated is likely going to occur. And if it's going to occur, is it 100%, 50%, or 80%? All right. Now let's look at the components of the financial statement. Okay, so James, you said you cannot see part of the screen.
Yes, please.
Which part? So what we have on the screen now, you can see up to what point?
From set, I can see the set of financial statements should include. I can only see the first ET of the first word from of financial statement should include.
That's what you can see.
Yes, please.
What about the other people in the class?
I can see.
He
can see everything.
From 1 to 6, A and B.
Okay. So then it's not coming from me.
Okay, sir.
So you have to adjust your screen to be able to view. Now, let's understand that, and as I mentioned over and over again, the financial statement will come as part of the annual report. But the financial statement component is a part that is regulated. The other parts are not regulated. So if you look at a typical report of the auditors, they will specify that these are the parts that they audited, and there are parts that were not audited. Now, so the first component, or what we're referring to as the financial statements, a set of which should include the statement of financial position. The statement of financial position. So if we have heard of the statement of financial position or the balance sheet, then that is what we're talking about. So the statement of financial position or the balance sheet. And it is a positional statement, so it should be at the end of the period. So say as at 31st December 2020. Okay. Then we have the statement of profit or loss and other comprehensive income. Okay, so that should be over a period. Then the statement of changes in equity, that is also over a period. Then we have statement of cash flows, that is also over a period. Then we have the notes comprising the summary of accounting policy and other explanatory notes. So these 5 constitute the financial statement. These 5 constitute the financial statement. But in a typical annual report, there will be other reports. So for instance, you have the auditor's report, you have the director's report. What are the other reports that you can think of? What are the other reports that you can think of? Yes, Lydia.
Please, the chairman's report.
The chairman's report. What's the usual content of the chairman's report?
Yes.
It's not directed to you, but
it gives it gives overview of the financial status of the organization.
Should that be the content of the chairman's report? Then what will be the content of the CEO's report? Yes, Kelvin.
Is the previous one?
Okay, but answer this. What are some of the other reports? I expect that everybody will get a copy of an annual report. Okay, so get a copy of an annual report. next report, I'll let you show it. Yes, Francis.
Hello, sir.
Yes.
But how about if they are board of directors?
Okay, so that'll be the director's report.
Oh, okay.
Okay. Yes, Godwin.
The chairman's annual report gives an overview of the key decisions taken in the year regarding the board meetings. I think chairman here means the board chairman.
Yeah, that's right.
Yes, so an overview of decisions taken by the board in the year. Exactly, and decisions to withhold or pay dividends is also.
Okay, so there are more policy issues. Great. Any others? Any others? Francis, your hands still up.
It's the previous one, sir.
Okay. Okay, so if you don't give me in class, in the exam, I will say, apart from these, list 10 others. Are you game? Are you going to mention them now? All right. And let me mention to you that apart from the financial statements, which are regulated and therefore are prepared using the IFRS, which is the standard that regulates or that is used in preparing financial statements in Ghana. All others do not or fall outside the scope of IFRS. So it means that the other parts, such as the chairman's report, the CEO's report, all of them fall outside IFRS. So if you are reading them, then and if you read the auditor's report, you see that they'll say that they have not looked at this. So their mandate falls outside the financial statements. So typically the annual report will have a number of reports, but what is regulated and is audited will be those that fall within the financial statements. I want you to understand. Okay. All right. Any question? We'll now go into, I think, should I go through this one? Okay, so I'll skip this one, then we'll come back to it. But now let's take the components one by one. Now the first one is the statement of financial position, or which we refer to as the balance sheet. The statement of financial position shows the state of affairs at a point in time. Okay, so the state of financial position. If you recollect when we're looking at accounting equation, we said that accounting equation, if you translate it in the statement form, then it is the financial position. And if you recollect, we said that anytime there's a change, anytime there's an activity, the financial position will also change. So the state of financial position shows the state of affairs at any point in time. That suggests that the financial statements, the financial position or the statement of financial position of an entity this morning may be different from the statement of financial position in the afternoon, especially if there's an activity. So it shows the investing and financing activities at any point in time. The statement of financial position is a snapshot. Okay, so just as if I raise my hand and you took a shot, and if I put it down, you took another shot, there will be difference between raising hands and putting their hands down. That's what the financial statement is. But it shows the investing and financing activities. So investing, we're talking about the assets, and financing, we're talking about equity and liabilities. And as I keep on mentioning to you, previously it was referred to as the balance sheet, but it's the same, whether the balance sheet or statement of financial position. But the statement of financial position presents the business as a holder of resources, which we refer to as assets. But the resources or assets are equivalent to the claims against those resources or assets, which we refer to as equity and liability. So typically, the statement of financial position will show the assets, will show the liabilities, and will show shareholders' equity. Now, so for the MBA class, what you are interested in will be what is in the statement of financial position, but not how to prepare it. So we are focusing on understanding what it is and interpreting it, rather than the mechanism of preparing the statement of financial position. Now, so typically, if you look at the statement of financial position, the items that you see will be assets, liabilities, and shareholders' equity. You see assets, you see liabilities, and you see shareholders' equity. So for you, what should be of interest to you will be issues of recognition, valuation, and classification. So if you pick an asset, we are interested in their recognition, we are interested in their valuation, and we are interested in their classification. And similarly, if you pick liabilities, we are interested in recognition, valuation, and classification. Okay. So we'll pick them one by one. Now, the first to pick will be assets. And I think 2 lectures before this one, we explain to you what an asset is. What is an asset? So by way of definition, what is an asset? What is an asset? Are you guys here?
Yes, please.
Oh, yeah, yes.
Yes, please.
What is please. Yes, Pandya. Yes, Francis.
So an item is an asset is an item or property owned by an individual or an entity.
Okay, so the discussion, I think we will not say is owned. Yes, George.
No, please, assets, they are resources controlled by an organization which has economic benefits.
Okay, so we said that assets are resources, but they are resources that are controlled by an entity. So if you have resources that you are controlling, and this is as a result of some past events, and you expect to benefit from it in the future, then that can be classified or can be or that's what we regard as an asset of an entity. Yes, Abdul Manan.
Oh no, I raised my hand for the question.
Okay, so ask the question.
No. For the question, I wanted to answer what an asset is. Sorry, I did not put down my head.
Okay. Yes, Francis. Yes, Francis.
It was the former answer.
Okay, all right. So, by way of definition, we should look at an asset as a resource that is controlled by an entity. So we are looking about control, the issue of control. And that ties in with how to recognize a resource as an asset. So if you're going to recognize as a resource as an asset, then you should have acquired rights to its use. So it brings in the issue of control. Okay, so resources that you have acquired rights to its use. And remember that the rights here, we are talking of property rights and not ownership rights. Okay, so property rights here has to do with right to use, right of control. Okay, then we are saying that that resource should bring you benefits, which you can quantify with some degree of precision. So, for you to recognize a resource as an asset, then these two conditions must be satisfied before you can recognize a resource. So, remember that to recognize a resource as an asset, these two sets conditions must be met. So, it is right to say that all assets are future benefits, but not all future benefits are recognized as assets. Or we can say that all resources that bring future benefits are assets, but it's not all future benefits that we can recognize as assets. So if there's a future benefit for which you cannot agree to these two, or that does not satisfy these two sets of conditions, then you cannot recognize it as an asset. Any question? Any question? Yes, Godwin.
Yeah, let's take a situation where companies or entities send their staff for better studies, purposely for future use. So can that resource be considered as an asset?
Okay. So can you quantify that resource, the benefits that accrue to it? Can you quantify with some degree of precision? Can you quantify that?
It will be difficult.
Yes, I thought you were asking the third one, but personally, I think it can be quantified as an asset. Perhaps that is why in government institutions there are bonds that are signed. Workers who go for this sign bonds because they are resourcing.
No. So
I think unless assets are only
what?
Big tangibles.
No, we are not talking about only tangibles. We are saying that the resource will bring you future benefits, and you can measure with some degree of quantity the benefits that will accrue to you. So I'm asking you, if you send people on a training assignment or on study leave, the benefits that will come to you, can you quantify that with some degree of certainty?
I can. Let's say I work in a health environment. I have a tier.
Your line is breaking. I can barely hear you.
Is it okay now?
Yes.
I was saying I can quantify the sense that, let's say I run a hospital, that I have a theater, so I've sent a nurse to go on study leave to learn on critical care nursing. So she comes back in 2 years to run that department, okay, giving critical care to people who have just undergone surgery and stuff. So in the next 3 years, I know the financial benefits, perhaps, of that nurse to their facility. So by quantifying that for the next 3 years, I can regard her resource, what she has gone to learn, as an asset to the facility.
So at what point are you quantifying? Is that at the point that she's come back, or at the point that you're sending her?
At the point that she's come back, because the bond starts right from her coming back.
Okay. Yes, Louis.
Yeah, Prof, I think for the initial stage that she is going, I can't quantify it as an asset because it will be a non-financial measure. because this is just the growth and the learning part of the company, which is a non-financial dimension. But at the point that she comes back, that's when the financial gain will be realized. So it's sort of an indirect financial gain. So at the point that she's going, I can't classify it as an asset to the company. To rather be a liability, because we are going to spend money to train her, and you are going to lose money.
Leonie. Yes,
I had a question, not regarding that though. But if we're talking about this one, I think it will be classified as an asset, because you made mention of the fact that it's any resource that has that might add benefits to the company in the future. All assets are considered as beneficial. So if I think that the training is going to add more value to my company, I'll consider it as an asset. Though I'm not getting it now, I know it's going to bring in more returns. That's what I think. But my question is, can we consider lease agreements as assets as well?
Okay, yes. So lease agreements should be considered, but we'll come to that. Let's try and agree on this. So you see, it is not what you think. It means that there should be consensus on the agreement as to whether a resource can be regarded as an asset or not. Okay, so if you look at human resource generally, they cannot be classified as assets. There are some human resource that may be regarded as assets, so like footballers. Okay, but if you're talking about your HR in your company, you cannot classify them as assets. Now, when we come back to a lease, indeed, a lease, you should have acquired the rights. So once you have so you see, the lease is the right to use. And here we're talking about finance lease, finance or capital lease. So finance or capital lease should be recognized as assets. But of course, there will be a complementary recognition of a liability, because once you enter into the lease agreement, then you are hooked to it and you have to now pay for the lease rentals. So if you look at them in today's terms, then that will be, so you have an asset and you have a liability. So for leases, and especially we're talking about finance or capital leases, they are recognized as assets because you have the right to use. The lessee has the right to use. So here we're not talking about ownership rights, we are talking of property rights. So when you enter into a lease, the lessor, what the lessor has will be the unpaid lease rentals, which they will recognize as their assets, not the specific asset that is under lease. So if, for instance, you bought a vehicle for me to lease, then you as the lessor, your asset is not the vehicle. Your asset is the unpaid rentals. Then for me, I have an asset which is the vehicle. So that's how it should be done. Yes, Leonie. Is it the old one?
Yes, sir. Sorry.
Okay. All right. So that's how assets should be recognized. If you're going to recognize a resource as an asset, then it must satisfy these two conditions. Now, once we finish with recognition, the next is valuation. And valuation has to do with assignment of monetary amounts. Okay, so valuation has to do with assignment of monetary amounts. And there could be several methods. Yes, Francis. Hello, Francis.
Yes, sir. Hello.
Yes, Francis.
Yes, sir. I wanted to actually advance the argument based on the fact that the human resource is a valuable asset to any company or entity. But then you concluded that it cannot be But then I feel like it should be because the success or failure of any organization, I think, is likely dependent on the caliber of people working therein.
Absolutely.
So I was just thinking about the fact I wanted to side with my colleague who says who was advancing that particular argument. But then when you concluded on that front, I was getting a bit confused.
What I concluded on which front? That's your good.
Oh, that the human resource cannot be classified, and you are making some comparative analysis with footballers.
Yes. So you see, what we are talking about is recognition and not classification. Okay, what we're talking about is recognition. And you see, I have mentioned to you that there's agreement on it. And that's one of the shortcomings of accounting. Items that cannot be quantified in monetary terms are ignored. So if you say that this is the benefit that I'm going to derive, can you quantify that in monetary terms?
Absolutely not, sir.
So for you to recognize as an asset for its inclusion in the statement of financial position, there must be a monetary amount attached to it. So if you cannot, then it cannot be recognized as an asset.
Okay,
so that's why when it comes to maybe buying a business, what is paid for will be more than the separable assets, because there are some assets that the company or the entity possess, but for which we have not been able to put monetary amounts on them, and it will include the human resource, because human resource is the most important resource of any business. However, if you look at the state of financial position, you won't find human resource there as an asset. That's the explanation that's trying to give.
Okay, sir. Got it.
All right. So once we finish with recognition, the next is valuation. And I mentioned that valuation has to do with an assignment of monetary amount. Yes, Kelvin.
Yes, sir. I wanted to add that taking a husband and a wife, for instance, because the man every morning takes out stock money or the housekeeping money, we can quantify that service as an asset. And because the woman does the washing, cooks, does everything, but we can't have that monetary value of it, we can say that is not an asset.
Your example is inappropriate. Gavin, your example is inappropriate.
Okay, thank you.
And who said that it's the man that brings the housekeeping money? Yes, Priscilla. Yes, Priscilla.
Sir.
Yeah, Bismarck.
You can move on, sir.
No, they've raised their hand. Yes.
Yeah, sir, please, I'm asking, if, for instance, it's a manufacturing company, can you classify the labor in the company as an asset, like maybe the labor, the human resource that actually produces maybe a particular product of a manufacturing company as part of the asset of the company?
Are you asking or you are saying?
I'm asking, sir, please.
No, you cannot.
Okay, thank you.
Yes, Bismarck, you had your hand up.
Sir, please, I wanted to know some of the assets that will not be classified currently as an asset, but in the near future be classified as an asset?
The asset that currently will not be.
Or not as an asset now, but in the future will be classified as an asset.
What's the source of this?
So with the last statement that was on the last slide.
Mm-hmm. So what we said was that, you see, you are recognized the resource now because you believe that it will bring you future benefits. Okay. So if you acquire a motor vehicle, you know that it's going to bring you future benefits. That's why you're recognizing as an asset now. Is that okay?
Okay.
Bismarck, are you okay?
Yes, please. I'm okay, sir.
All right. Okay, so let's go back to yes, Leonie.
I'm not okay. Why would I consider the car as an asset? I've spent money buying the car, and I've also spent money sending my staff for the training. Is it not the same thing? At that same moment, I don't know. I don't get it.
Who gets this? Who can explain it to you? Yes, Adam.
Okay, good morning, sir. Good morning, class. In my thinking, accounting is all about financial reporting or stating the financial position of the company. So if you send a staff for training, that is very good for the company. But what measures are you going to use to know that, okay, say we send 5 people for training. Kuti is worth 20,000, Ama is worth 15,000, Ya is worth 18,000. How are you going to get that figure? Let's say your profit increases. What shows that these are the only people who increase their profit? Maybe demand increased and that is why profit has increased. Yes, they will add to the efficacy of the company, but how are you going to put financial value on their upgrade in their skills? So I think that is why we can't include it, because there is no way you can say the experience or the people they have acquired is worth 2,000 cedis, is worth 100 cedis, is worth 5,000. There is no practical way. That's what I'm saying.
Okay, thank you very much. Okay, now so let's look at valuation. And valuation, we're talking about assignment of monetary amounts. So if you recognize as a resource as an asset, there must be a value on it. So what is the value? And the value will depend on the method that you are using. So we can talk of the acquisition or historical cost. So what is the acquisition or historical cost? Yes, Anne.
Basically, the asset is budgeted according to the price or amount that was initial when the transaction was made. The amount agreed
the transaction value.
Yes,
very good. So the transaction value.
You spend 5 for training.
And then I'm going to remove it from the class. So if we, Anne, what's the value of your car?
Probably 20,000. Yeah, I'm not sure.
You're not sure?
Let's say maybe.
So, why you didn't pay for it?
No, please.
Okay. So So, Anne.
Yes, please.
So, if you have the invoice or you have the check value, how much it was paid, then that will be the acquisition or historical cost.
Okay. So that's you are talking about the, if so to say, what was given to you at the point to show what you paid for the item.
Yeah, that's right.
Okay.
So that is the acquisition cost or the historical cost. Then we can also, so we're saying that the acquisition or historical cost is usually the transaction price, so the price that you pay to acquire that resource. So you can put that value. So when you prepare your accounts, you can put that value to represent that asset. Then you can talk of the current replacement cost. So the current replacement cost has to do with the cost of the assets at its current state, but not with a new one. So if you have an asset and you have to replace it at its current state, but not with a new one, then what will be the cost? So for instance, you have taken an insurance, and if you took an insurance and a comprehensive insurance, and the car is involved in an accident and stuff like that, so what the insurance company will pay to will be the current replacement cost. They will not give you a new one. They will give you based on the amount that you have insured, which could represent the current replacement cost. So the current replacement cost may be different from the acquisition or historical cost. So assuming you bought a vehicle, so assuming we bought we bought an asset costing, so maybe a motor vehicle, that costs 60,000. Now, so this was bought say 5 years ago, or let's say 2 years ago. Okay. Now, so if I ask you what the current replacement costs, you may decide that okay, let's depreciate it for 2 years because the asset has been in existence for 2 years. So if you depreciate for 2 years, and assuming the asset is going to last for say 6 years, if you depreciate it for 2 years, then it will because, and assuming you are using a straight line method, if the asset is going to be for 6 years, so you assume that every year is 10,000. So if it's been for 2 years, it means that 20,000 is gone. So you may say that the value now is 40,000. But if you bought 60,000 2 years ago, it's likely you cannot replace it at 40,000. So the current replacement cost may not necessarily be 40,000. So a way around it would be to convert this into dollars. So you convert the 60,000 into dollars when it was acquired. So 2 years ago, what was the exchange rate? 2 years ago, what was the exchange rate? Hello? 2 years ago, what was the exchange rate? So let's say, yes, Bismarck.
$1 to 4 cedis.
$1 to 4 cedis. 2 years ago.
Yeah, 2 years ago.
My friend, I should.
B is 4.8.
Okay, so let's say 5. So if we use 5 cedis to the dollar, then it means that this would have been how much? 12,000. It will be what? If you divided this by 5, it will be 12,000. I mean, hey, are you guys here?
12,000.
Yes,
sir. 12,000. Yes, sir.
Okay, 12,000. Now, so if it is 12,000 and you are still using the standard method, so the depreciation for the 2 years will be 1 year will be what? Depreciation for 1 year. Are you guys here?
$2,000.
$2,000. Okay, so every year will be $2,000. So for the 2 years, it's going to be 4,000. Is that okay? Yes. So if 2 years is 4,000, then it means that in dollar terms, what is left will be 8,000. Now you can multiply the 8,000 by the current exchange rate, and let's assume that the current exchange rate is 6 cedis to the dollar. So if you multiply the 8,000 by 6, there's going to be 48,000. So the current replacement cost will be 48,000 and not 40,000, because you are assuming that the CD is not, the currency is not stable, and therefore you want to look at the more stable currency. So if you do that, and if you are holding 48,000, it's likely you can pay for the car that you bought 50,000 2 years ago. So that is what we refer to as a current replacement cost. So you want to replace an asset with the asset at its current state, but not with the new one. So that's what we refer to as a current replacement cost. Any question? Any question? Any question? Okay, so that's current replacement cost. Then the next is net realizable value. Okay, net realizable value. And net realizable value represents the value of an asset after taking into consideration the cost of selling the asset. So it's in accounting and finance. If you want to sell an asset, you can say realize it. So if we say realize it, means that sell it. So the realizable value means the value that you can gain from selling. And if you take away costs from it, then that becomes the net realizable value. Okay. So if you have an asset, the inventory, and each of them is 6,000 cedis. So you have 10,000 of them, and each of them is 6 cedis. Now, assuming the inventory is damaged, and because of that, you cannot sell it at 6,000. So the 6,000 is the cost, and you can only sell it at 4 cedis. But when you sell it at 4 cedis, you must pay a commission of say 1,000, or let's say 500. Then what will be the value that it should represent in your books? Remember that we have an asset called inventory, and there are 10,000 pieces. So if each of them is 6 cedis at cost, then that will be 60,000. But we are told that the asset is damaged, and because of that, we cannot even sell at the 6 cedis. We can only sell at 4 cedis. So if we are able to sell it, then it's going to give us 40 cedis, 40,000 cedis. So So the 40,000 cedis represent the realizable value. But because we have to incur a cost of 500, we have to take the expenses of 500 from it, and it becomes 39,500. So the 39,500 represents the net realizable value. Okay. The 39,500 represents the net realizable value. Yes, Lydia.
Yes, sir. What if you sell and you gain profit?
Okay, so we are talking
Supposing
about.
they are not damaged.
Okay, so assets. Please mute your microphone. Microphones off. Giving us feedback. So let me introduce you to an accounting concept. It says that you must be wise, or we refer to that as the prudence. So the prudence says that you must be wise, and because you have to be wise, you don't have to anticipate for profits. Okay, you don't have to anticipate for profits, but you have to make provision for all known losses, so long as you can have a reasonable estimate of it. Now, so if you have stock and it is costing you 6 cedis per unit, and you sell it, you can sell it as say 8 cedis. When you want to value your assets for inclusion in the state of financial position, you're not going to say, oh, if I sell it, I'll be able to sell it at 8 cedis. So I'll now multiply the 8 cedis by the 10,000. It means that you are anticipating for profits and you are going against the prudence concept. So because of that, you are only going to use the 6 cedis. However, if you cannot sell it at 6 cedis and you are going to sell it below the 6 cedis, then the prudence concept is still applicable, that you have to make provision for all known losses. So because you know that you cannot sell it at 6 cedis, but you can sell it at 4 cedis, then reduce it to the value that can come to, which we're referring to as the net realizable value. So when you're recording the assets, we say that you should record at the lower of cost or net realizable value. So the cost and net realizable value, whichever is lower, that is what we should use, and not what you anticipate to be your profit. Is that okay, Lydia? Hello,
Yes,
Lydia.
yes, Prof. Thank you. Yes.
Okay, so
yes, Prof. Thank you.
Yes, Ebenezer.
Yes, Prof. So now let's assume we have a vehicle with a depreciation value of 20% per annum, and it goes 5 years. So the value of the vehicle is now at 0. How do you treat this?
It's what?
Check it.
If it's mobile, it gets mobile.
Yes, sir. Thank you, sir.
Yes, Steven.
From the explanation paper, can you see that the net realizable value can be expected selling price minus the total production or the selling?
Your line is not good. I cannot hear you.
I was saying that,
are you close by your set? You appear far away.
Yes, I'm good.
Yes.
Are you hearing me, please?
Yes, go ahead.
What I was saying that based on your explanation from your end, can you see that the net realizable value can be expected selling price minus the total production or the selling cost?
No, if you do it that way, you are wrong.
Okay.
Okay, so you see, what we talking about here has to do with where the net realizable value is lower than the cost. So if the net realizable value is more than the cost, ignore the net realizable value and use the cost. If the net realizable value is higher than the cost, ignore it and use the cost. But if the net realizable value is lower than the cost, then use the net realizable value. Okay, so let me give you an example. So everybody should write. So you have inventory, 10,000 pieces or 10,000 units. The unit cost is 5 cedis. Unit cost is 5 cedis. And the unit selling price is 8 cedis. The unit selling price is 8 cedis. Now, as a result of new discoveries, you can only sell the product. At 70% of the unit selling price. You can only sell the product at 70% of the unit selling price. Then, estimated cost is 50 pesos per unit. The estimated cost is 50 pesos per unit. What should be the basis of valuing the stock for their inclusion in the statement of financial position? What should be the basis of valuing the stock for their inclusion in the statement of financial position? Who is finished? Who is down with the solution? Yes, Emmanuel.
Good morning, sir. If the cost of the item is 5 cedis and we have about 10,000 pieces to sell at approximately 8 cedis, and then because of the new million, we are supposed to sell it at 70% of the selling price of 8 cedis. We get 5 cedis, 60 pesos. So if each we are incurring additional cost of 50 pesos to sell, that means the sell price comes to 5 cedis, 1 peso, which is more than the initial cost price of 5 cedis. So in this instance, the net realizable value holds more than the cost.
Which one? So what should be the basis of valuing the stock?
Sorry, sir.
So you're on track, but the last bit.
So sir, we'll use the net realizable value because it's 1 peso higher than the initial cost value of the asset.
So we should value it at net realizable value?
No. Yes, please.
Cool. But have you forgotten the prudence concept that I mentioned to you? Yes, Randy.
Okay, sir. Good morning. Yeah, so calculating 70% of the unit selling price will give us 5.6. 5 is 60 pesos, which is more than the unit cost. So using the prudence concept, the unit cost for producing is lower than the net realizable value. So we'll use the unit cost, which is 5 cedi. So 5 cedi times the 10,000 of the inventory will give us 50,000. But we incurred the estimated cost in selling is 50% per unit, which is also 5,000. So It's 50,000 minus 5,000, which will give you 45,000, which will be captured in the balance sheet or the statement of financial position.
Not quite. Yes, James. Okay, Emmanuel, you want to come back?
Yes, sir. Earlier.
Yes, no, but you were on track, except that it's the last bit that got us confused. Yes, Louis.
Yes, sir. Please, following what Emmanuel said, I was on the right track, getting like 5.1 for the net realizing value. If you multiply it, you're going to get 51,000, which is more than when you multiply the cost, which is 5 cedis, by the unit, which is 10,000, which you get 50,000. So from the concept that you gave, you said if the cost is more than the net realizable value, you will use the cost. So that means that we are going to record the 50,000 inside. Yes, if it's less than the net realizable value. No, if the net realizable value is more than the cost, you are going to use the cost. So in this sense, you are going to record 50,000.
Great.
In our books.
So we are looking at the lower of cost and net realizable value. The lower of cost and net realizable value. So if you look at the cost, which will be 50,000, and the net realizable value, which will be 51,000. So the 50,000 is lower, and because it's lower, that is what we are going to use. Okay, so that's what we're going to use. So use the lower of cost and net realizable value. Yes, Stephen. Yes, Stephen. Okay. Let's see those. If you couldn't do it, let's see if you have a problem. They will have those who couldn't do it. If you couldn't do it, let's help. Yes, and there. What's the issue?
I couldn't do it.
Okay, so what was your difficulty? Let's see your difficulty. Then we'll have. Yes. Or you simply didn't try it at all?
In fact, I didn't try.
Oh, so if you didn't try, then that one, you can't help.
But how did they work it?
Okay. So Solomon.
Yes, sir.
Yes. How did they work it? Yes. How did they work it? Okay, so we want to determine the value of stock to be included in the statement of financial position. Now we're given that the company had 10,000 units products, but each of them costs 5 cedis. So based on cost, then the value will be 50,000. But we are told that there are new discoveries, and because of that, we can only sell it at 70% of the selling price. And the selling price is 8 cedis. 70% of 8 cedis give 5 cedis 60 pesos. So for each of them now, we can sell it at 5 cedis 50 pesos. But to be able to sell it, we have to incur a cost. Also, it's going to be an expense of 50 pesos. So if we can sell it at 5 cedis 60 pesos and incur a cost of 50 pesos, then the net realizable value is 5 cedis 10 pesos. So the 5 cedis 60 pesos represent the realizable value. and the expense is 50 pesos. So if you subtract the expense from the realizable value, then that will give us 5 cedis 10 pesos. That is the net realizable value per unit. So if you multiply the 5 cedis 10 pesos by the 10,000, it will give you 51,000. Now, if you so that is the net realizable value. So if you compare the net realizable value of 51,000 with the cost of 50,000, then the cost is lower. So we ignore the net realizable value and use the cost, which is the lower of the two. That's how it was done. Okay.
Thank you.
Then we can also use the present value of future net cash flows. And this basically talks about the time value of money. So a cedi today is worth more than a cedi tomorrow. So, and this is used for assets that are quantified in monetary terms. So assuming you have an asset in the form of series of receipts, then what you do is to bring all of them into today's terms, and that will be the value. Okay, so let me use this simple explanation. Do we have somebody here that has a taxi or car work and pay? Do you have somebody here, or maybe?
Yes, we do.
Okay. What is the value of that asset?
30,000.
80,000. Why is it 80,000?
That's the value at which the asset was acquired.
Okay, so you see, that is not the asset to you. The asset to you really will be the series of monies that the person will pay to. So if you are valuing that's what you should use to value the asset. So if they are going to bring you, how much do they bring you per week? Is it per week or per day or per month?
Per week.
Per week. And how much are they bringing you per week?
360.
360.
Yeah.
Okay, so if they bring you 360 this week, and next week they bring you 360, the 360 this week is not the same as the 360 next week because of the time value of money. So you expect that they will bring you 360 over how many weeks? They'll bring you
if it's a month, then 4 weeks.
No. How many do you expect bringing you over the lifespan of the assets? You expect it's going to be over 2 years or over 3 years or what is it?
Hello, sir.
Yes.
Okay, sir. So now the thing with work and pay is that if you acquire the vehicle for say 30,000, we usually multiply it by 2, so it goes to like 60,000, and that becomes what is realizable usually over a 2-year period, and then the payment is done on weekly or bi-weekly basis for the 2-year period. So my confusion here would be what becomes the real value. Is it the 60,000, which is what we have agreed on, or the 30,000, which was the purchase price?
So you see, so what you do is that your interest in the vehicle is not the vehicle itself. Your interest in the vehicle is the series of payments that the individual pays you. Okay. So if they are going to pay you 500 a month, the first month you're receiving 500, second month you're receiving 500. What I'm explaining to you is that the first month 500 is different from the second month 500 because a cedi today is worth more than a cedi tomorrow. Now, so what you do is that you discount all the monies into today's terms, and if you discount them to today's terms, then that becomes the value of your asset. Okay? So if you know the cost of capital, what you do is to use that to bring it to today's terms. So we talk about the present value. So if somebody is going to pay you 10,000 in a year's time, it's different from if they pay you 10,000 now. Because if they paid you 10,000, we'd have invested it and made a return on it. So the 10,000 in a year's time is not 10,000 in today's days. It's lower because you have to discount it into the present value. And that's what we're talking about. So when you have assets that come in the form of cash, series of cash receipts, what you do is to bring it to today's days. And that becomes the present value. Okay, let me explain something to you. Has somebody taken a loan recently? Yeah, Solomon, I can see that you have you taken a loan recently?
No, sir. No, sir.
Why? You don't want to use people's money to create wealth?
Yes, please. I don't want to do that for now.
Who has taken a loan recently? Oh, my friends, quick.
Hello, sir.
Yes.
Yes, sorry, I just remembered. I took a quick loan.
Okay. How much was it?
It was 800.
800 cedis?
Yes, please.
My friend, what kind of loan is that?
That's quick loan, MTN.
Okay. Has anybody taken a car loan or something? Let's use it so that you can understand what I'm trying to explain to you.
That is not me, but my sister took a loan.
Yes, Belinda.
Yeah, I took a loan from the Ministry of Finance.
How much was it?
20,000.
20,000.
Yes.
And how much are you supposed to be paying? And over what period?
I think it's 2% per annum, but I don't know the deduction. They've not started deduction yet, so I don't know how much it will be deducted from my salary.
Okay. Yes, to me.
No, my sister took a loan. It's not me, but my sister.
Yes, your sister. How much?
15,000, sir.
16,000.
Yes, 15.
Okay, 15,000.
Yes.
Over whole period. What's the repayment period?
3 years, sir.
How many years?
3 years.
3 years. So that will be 36 months. And how much is supposed to be paying?
A month.
How much?
650 a month.
650.
Yes.
Times 36 months.
Yeah.
So that will be 23,400.
Yes, sir.
Okay, 23,000. So by the time your sister finishes paying, you would have paid 23,400. Okay. But the present value of that is the 15,000. Okay. The present value of that 15,000 and 23,400 is 15,000. So if you discount them by using the exchange, the interest rate, it will come to 50,000. So that's what we're talking about. Yes, listen. What's it? What's the issue? You're getting feedback from me. Yes, Belinda. Are you okay with this? Okay. Then we have the fair value. And the fair value represents the value that you put on an asset, assuming that we are not going through any form of false sale, and where there's agreement because everybody is operating on an arm's length. So the price that currently you pay for an asset, and for which it is not under any force majeure or force sale, and it's at arm's length, will be the fair value. So these are the various valuation methodologies. There are a number of them that we have not discussed. So there are several methods that you can use to value an asset. So these 5 represent them, some of them. Now, when it comes to classification has to do with groupings. So you look at assets that are similar and group them. And depending on the similarity, some companies may classify assets based on their location. Okay. So some companies may group assets or classify assets based on location. So if they have assets at Kumasi, they can put all of them together as Kumasi assets. Assets may also be classified based on function. So sometimes, if assets perform similar functions, they may be put together. But for purpose of financial reporting, assets may be classified into 2 main. We have 1 current assets and 2 non-current assets. So assets may be classified into current and non-current. Can you give examples of current assets? Examples of current assets. Yes, Randy.
Cash at bank.
Cash and bank. Okay, great. Any others, George?
Accounts receivable.
What? Receivables. Okay.
Yes, please.
Yes, James.
Stock or inventory.
Okay, all right. Then we can talk of the non-current assets. So the non-current assets may include property, plant, and equipment. So if you read some books, they will refer to them as fixed assets. But for purpose of financial reporting, they are classified as non-current assets. So they could include investment. So if you have shares in another company, if you have bonds in another company, so that could be classified. They may be classified also into biological assets or manual. So these are the various classifications. Okay. Any question? Then the next after assets will be liabilities. What is a liability? If you recollect, when we're discussing the accounting equation, we explained to you what a liability is. What is a liability? What is a liability? So we should see a liability as an obligation. And that obligation, which, okay, so George, yes.
Current liabilities are obligations of the business to persons other than the owners.
Mm-hmm. Okay. Yes, Frank.
Sir, please, liabilities are financial obligations that firms or organizations need to pay to other parties.
Okay, all right. So the obligations that you have to settle, and this was as a result of some past events or transactions. And if you're going to settle, it will lead to outflow of resources. So that is the definition for liabilities. But once you have liabilities, then the next is to recognize them. And if you are going to recognize them, there are 3 set conditions that must be met before you can recognize an obligation as a liability for their inclusion in the balance sheet or statement of financial position. So 1, the firm should have received benefit and in exchange promise to pay, and the payment will occur at a definite future time. So these 3 conditions must be met before you recognize an obligation as a liability. 1, you should have received benefits, and the exchange promise to pay, and the payment will occur at a definite future time. So these conditions must be met. So that suggests that all liabilities are obligations, but not all obligations are recognized as liabilities. Okay, so there can be some obligations, but because they do not meet this set criteria, they may not be recognized as liabilities. Let me find out from you. So assuming there's a mining company and they go to the community and they tell the community, we are going to build your KVIP. Would they recognize this as a liability in their financial statements? Would they recognize this?
No.
Why not? Yes, Belinda, why not?
I think it will be recognized as a social responsibility to the community.
Okay. All right. What about if they have now contracted somebody to put up the school, except that they haven't paid? Would they recognize the obligation to the contractor as a liability?
Yeah.
Yes.
Okay.
Yes, Doc.
Yes, Doc.
Okay. So that's how to recognize liabilities. Now, once you have defined and recognized liabilities, the next is valuation. And remember that valuation has to do with assignment of monetary amounts. Assignment of monetary amounts. So when it comes to valuation, there are two main. Then we can also talk of the fair value. Now, liabilities that you have to be settled within a little bit shorter period, say a year, are valued based on the cash payments. Liabilities that are to be settled within a little shorter period, say a year, will be done using the cash amount that they expect to pay. So if I come to you and I tell you, give me 500, and I'm going to pay you 500 in the next few years, then the obligation or the liability that I will put in my financial statement will be the 500, because that's the cash amount that I'm going to use to settle. But if the liability will be paid over a year, then it will be based on the present value or the net present value or the future cash payments. Okay. So if you took a loan, so for instance, the loan that we just talked about, by the time the individual finishes paying, they would have paid 23,400. But that is the future value. So if we bring it to today's stage, or we discount them using the exchange rates, it will be equivalent to 15,000. So what we are going to include as our liability will be 15,000 and not within the 3,000. So because what we have done is that we have discounted them into their present value, and that's what we're using as the liability. Yes, Belinda.
Oh, sir, please, it was the previous answer. Sorry.
Okay. Yes, Frank.
Sir, please, it was the previous hand, sorry.
Okay, all right. All right. Any question? Any question? All right, so let me spend some 2 minutes to explain to you the okay, no, it's okay. Let me just. So we'll meet and discuss it next week. If you have questions, let me take. Otherwise, thank you for coming. Try and come to class early so we can start right away. Okay. Any question?
Hello, sir.
Yes.
Please, this is Emmanuel. I don't know if it's just me or it's everybody else, but I don't have access to the lecture slides and the videos on my Sakari. I don't know if it's just me.
It's not just you.
It's not you alone, all of us.
Yes, Priscilla.
Sir, please, I wanted to ask a question based on the last lesson that we did. That, for instance, if you are not capturing what I will call interest of maybe a liability, that you are supposed to be paying in the future. How then do you plan for it if you don't capture that in your books as part of your present liabilities?
Okay, so you don't do that, but what you do is that you prepare. So the liability is showing the state of affairs. But if we're talking about the operational issues, that will come in the statement of profit and loss and other comprehensive income. That's where it is captured.
So you won't capture that in the financial statement, in the financial position, sorry.
You won't capture interest.
Interest, yes. Interest that you are going to be paying.
No.
Which is a liability.
No, interest that you are going to pay is not a liability. It's an expense.
Okay. All right, thank you. Thank you.
All right, so I'll let Peter send you the slides and the videos. All right, so bye-bye.